Hello there, everyone. Dave Keller here with Market Misbehavior. I'm the president and chief strategist at Sierra Alpha Research, and thank you so much for joining me here today on my weekly show on Stockcharts TV. Today, we're going to talk about sentiment, and we're dropping a show on sentiment around 2 p.m. Eastern on Monday, April 21st, as the markets appear to be accelerating to the downside after last week's arguably, distribution signals in a shortened holiday week. Today here on Monday, the market accelerating to the downside. So we're going to unpack a little bit sort of that downside deterioration in the S&P 500, but focus on a couple sentiment indicators that I find really helpful. Just to take a step back briefly, when I think about market conditions, sort of a macro, big picture market assessment, I kind of have three pieces to that, right? First is price. Price is always most important. And one of my mentors, Ralph Atkimpor, always used to say, if you know nothing else about the markets, know the daily chart of the S&P 500. I took that to heart years ago, and true to form to this day. Every day I start with the S&P 500. Weekly chart is my first chart, and then the second one is the daily chart of the S&P 500. So Ralph, I was listening all those years ago and continue to stick with that routine today. After price, though, it gets into breadth conditions. And we've talked a lot about breadth conditions here on Stockcharts TV, certainly on my market recap show called Chart This with Dave Keller. We regularly bring up breadth conditions. And to be clear, the breadth has deteriorated really going into the February peak, right? If you look at breadth from late December to late February, totally different and much weaker. Really accelerated to the downside into the low earlier this month in April of 2025. A lot of short-term breadth indicators bouncing pretty aggressively, but overall, I would say the long-term breadth conditions still remain quite negative. And then we get to sentiment, and sentiment is I think a crucial third piece of that macro analysis, because price really tells you how supply and demand nets out, how fear and greed all sort of are aggregated into price action of equities and ETFs and major equity indexes. Breadth conditions tell us about participation. So those tell us about a lot of the individual stocks that make up those benchmarks, and if there's some differing signals that we need to pay attention to. But sentiment is where we actually hear what people are thinking, whether that's through survey data and what they say they're thinking, whether that's through volatility data, which helps us understand how they're, making changes to their portfolio, what sort of trading activity they're doing, and also positioning data, things like a NAAIM exposure index, which will basically tell you how investors are positioned. And so we're going to talk about three different sentiment indicators, how they work, how they're calculated, but particularly what they're telling us right now as we sort of continue through a tumultuous Q2 in 2025. All right, so just to set the table for our discussion that we're going to have here, this is what the chart of the S&P 500 looks like today. And if you ask me, am I surprised that the market is selling off here on Monday? I'm not. Certainly with the headlines that we saw over the weekend, sort of I would say constructive criticism on Fed Chair Powell's performance from the White House, I think is certainly weighing on the markets here. But also, when you look at last week, I think what was so noteworthy in the shortened holiday week going into the Easter holiday is that every trading day of the 4 last week closed below the open, right? So instead of investors and traders seeing a higher open and then buying into that short-term strength, we saw those higher opens being met with selling. So traders were distributing, right? There was more supply in the market as opposed to an increase in demand. An increase in demand, if people are willing to pay more and more, that's what makes prices go higher. If there's less demand and or more supply, right? If there's more people unloading shares because of short-term strength, that's going to weigh on the price action. I think that's what we've seen going into today. So the severity of the sell-off certainly concerning here so far on Monday into the early afternoon. I would say the signs of distribution after that rally, 2 weeks ago, Wednesday. From then on, it's been more distribution than accumulation by most of the readings that I would have, or most of the charts I would look at. All right, so let's talk about a couple sentiment indicators here, 3 in particular. We're going to start with volatility, then we'll talk about survey data, and then we'll talk about some positioning data as well. So to start off with, when we talk about volatility, the VIX is obviously super important. I had a podcast interview about a month ago with Jay Soloff. He's the chief options analyst at Investors Alley. I've interviewed Jay a number of times over the years. Really thoughtful options trader and educator, and he did a fantastic job giving a sort of VIX 101. What is the VIX? What does it mean? What does it tell you when the levels are where they are? What does an increase or decrease in volatility tell you about sentiment in the options market, and how we can use that to, really make assumptions about the underlying S&P 500 and other stocks. So please make sure you go check that out. It's on my YouTube channel called Market Misbehavior. Really good interview with Jay Soloff. So if you want to learn more about volatility, I would certainly point you there. But what can we summarize in terms of the VIX? Well, a couple observations. Number one of the things I learned from Jay, and I'd heard it before, but I think Jay really described it well, was, remember the value of the VIX. The actual number level has meaning, right? So when the VIX is at 16, that basically tells you the market is pricing in an average 1% move in the S&P to the upside or the downside, right? So the VIX is basically using the implied volatility in the options market to tell you what investors are expecting, what the options market is pricing in terms of movement in the underlying index, in this case, the S&P 500. So the VIX at 16 means we should be having probably about a 1% move. So the VIX up around 35, which is where we're at today, means much more than a 1% move on an average day. A VIX up around 60, which is where we hit on an intraday basis earlier in April, tells you even more. So the percent swings we're seeing in the S&P and in the NASDAQ day in, day out are pretty much reflected, or at least that expectation is being reflected with the VIX remaining so elevated. Now, one of the things we saw back here in July into August was a spike in the VIX to one of its highest levels ever, right up into the mid-60s. But you can see that within a week, we're all of a sudden right back down around 20s, right? So it was a huge spike in volatility, but then a huge decrease in volatility. Compare that to what we saw so far in the month of April, which is a big spike up to 60, but then we've remained elevated. We haven't gotten much below 28 or so since that initial spike higher up to a similar level that we saw in August. So what we're seeing, I would say, in April of 2025 looks very different than what we observed in July and August of 2024, which was an increase and then a sudden spike, but then an immediate sort of recovery where volatility got back relatively low. The uptrend in the S&P continued. That was after that July-August pullback of last year, if you remember that. So the volatility now looks very different from anything we've seen from the VIX going back for the last couple of years. Now, a conversation with Dave Landry, who I've known for a number of years, a fellow Stockcharts contributor over time. He and I have talked, and he reminded me about the fact that it's not necessarily just about specific levels. It actually tests better, in his opinion, his analysis, is thinking of the range in the VIX. And this is something I've talked about in terms of what I call volatility regimes, right? There will be a period of time, like mid-2023 to early 2024, where the VIX kind of fluctuates between around 12 on the lower end, about 20, 24 on the upper end. So pretty much that's the range. You wouldn't expect the VIX to spike much higher. You probably wouldn't expect the VIX much lower, because this is the general volatility that the market is experiencing during that period. And that's what the market is pricing in. Back in 2022, the last real bear year that we had for the S&P 500, you can see that the VIX rarely got below 20. And on sell-offs in the S&P, the VIX often hit a resistance around 35. And I've have some shaded areas back here to sort of illustrate that. So in more of a bearish phase, the volatility tends to get elevated and then remain elevated. So if you're waiting for the VIX to get all the way down to like 12 again, which was where we often had, at least, maybe some sort of top back in 2023. I think you might be waiting a long time, because we're more in sort of a 2022 kind of volatility regime than a 2023 or early 2024 volatility regime. Certainly seems to me like the volatility has increased and is most likely going to remain increased. Now, what causes that volatility? You have to remember this VIX is calculated by the options market, right? And looking at the price movements of options, the premium, how they fluctuate for the options market. But it really is it's implying a volatility for the S&P 500. And I don't know about you, but given the headline risk that we've experienced in a very extreme fashion in the last couple of weeks, certainly seems to me like expectations of greater swings in the S&P is a very reasonable expectation right about now. So I'm not surprised the VIX remains elevated. It tells you if you're looking for those like early 2024 kind of weeks where the major averages are up or down less than 0.5%, that's kind of the norm. I think that'll be the exception. We've seen those random days here in the last month, but very, very rare. The average day has had a much higher price swing because investors are dealing with a lot more uncertainty, certainly elevated risks to the upside or the downside, elevated, potential for movement, and all that translates to the VIX remaining higher. So what does that mean for the S&P 500? Well, if you look back to periods where the volatility has remained fairly high, you're going to find years kind of like 2022. And this is one of those sentiment indicators that I would tell you, that I would suggest is going into a very similar sort of pattern and regime that we've seen in previous bear market cycles. It's one of those things that does not make me super confident about a big recovery just yet for the equity markets because volatility remains so extreme. I've had a lot of conversations with a lot of people about what levels on the VIX are so meaningful. And I have this purple line here, which is around 28.5, 29. That came from a conversation years ago with Tim Hayes, who's the chief strategist at Ned Davis Research. And in the institutional community, Ned Davis is one of those independent research shops followed with a wide following of institutional money managers for decades and decades. Going back to the 70s and 80s type of depth, and it really made a name for themselves in terms of their ability to analyze deep data sets and come up with some actionable perspective based on where we're at right now relative to where we've been. And in an interview I did with Tim Hayes a couple years ago, we talked about their analysis on the VIX, and he said what they learned was anytime the VIX gets above 29, that's where the forward-looking returns are actually pretty negative, particularly in that 3 to 6 month window. Longer term, right? If you go out a year or two, forward-looking returns are usually pretty good, and I think that's more of just speaks to the fact that generally speaking, markets are trending higher. But the VIX remaining above 30, which it looks like we are continuing to do now going into this new week, certainly tells me to expect more downside until volatility starts to come in. And again, the range I'm seeing in the VIX is very similar to previous bearish phases. Now, if you think the VIX seems noisier than normal, it's not just you. There's actually an index that's the VIX of the VIX. The CBOE, the Chicago Board Options Exchange, actually releases. They actually create the VIX and track it and release the official data on it. They also do a VIX of the VIX, so a volatility of the volatility reading, and that's $VVIX on the Stockcharts platform. You can see here that generally speaking, over the last 6 months, the VIX of the VIX is much higher. I wouldn't worry too much about the numbers. Just look at where we're at right now versus over the last 2 years, and you can see that the VIX of the VIX in early 2024 much lower, right? Meaning the VIX itself was having less severe movements. Now we're seeing extreme moves in volatility in early August of last year. Now in April of this year, those two spikes that we saw in the VIX certainly lining up with increased uncertainty. So volatility itself is becoming more volatile. It's very meta, I know, but basically the VIX is fluctuating quite a bit. It's generally trending higher, remaining in an elevated range. I think that is a negative sign for stocks until proven otherwise. All right, second thing we can do besides looking at the options market and digging into volatility is looking at survey data. And there are a number of surveys that I've followed over the years, Investors Intelligence, Market Vein. There are a number of them that are out there, all with their strengths and weaknesses. I tend to use the AAII survey. It's one of those data sets that's been around for a long time. So you can go back for decades worth of data on a platform like Stockcharts, which is really cool to just see what these surveys looked like during previous bull cycles, previous bear cycles, during transitions and inflection points. You can get a sense of just what the surveys tend to do, and then start to make some inferences based on what we see the current levels. So this is the chart that I use to track the AAII survey. Here's the weekly chart of the S&P with the 40 and 150 week simple moving averages. Here I'm showing the weekly reading of bullish and bearish votes in the AAII survey. There's also a neutral vote. You're asked, are you bullish, bearish, or neutral on stocks for the next 6 months? I don't show the neutral rating just for simplicity, but whatever's left after those two is going to be represented in a neutral bucket. And then here I'm showing the net difference between bulls minus bears. So just to explain, right? This is a weekly survey of individual investors. Every week they get emailed a ballot, or you might just do it on the website. I'm not actually ever voted in the survey. I may want to at some point just to experience it and share my own experience. But basically, that's the question. If you look, you can see that in both phases, the bullish reading will often get up to around 50%. Usually not too much higher. I've randomly, occasionally seen it get up to around 60%, but incredibly rare. Even in very bullish markets like 2021, we never got all the way up to 60%, right? But very, very close, like 58%. But here in like 2021, you can see the VIX sort of settles in around 45, 50%, spends most of its time there. Then you look at 2022, you can see the bullish reading never really got above like 25, 30% maybe at the most, and often got down to below 20%, down here around 15% in April of 2022. Look at where we're at right now, which is around 25%. I have that horizontal line to show you that the readings we're seeing so far in the last 6 to 8 weeks, much more similar to the readings that we saw like in 2022 than in bull years like 2021 and 2024. So indeed, when the market sort of rotates to a more bearish trend, while you can get very negative sentiment, sort of bombed out capitulation-like negativity at major lows, I think these surveys are more helpful for understanding sort of the general sentiment shifts and recognizing the fact that right now, the way that the voting has been trending from mid-February at the market peak to now mid-April is really very similar to 2022, right? Where you sort of fluctuate between around 15 to 25% of a bullish reading every week. That's literally been the range we've been in since the February peak for the S&P 500. The bearish reading has been down around 55 to 60% every week for the last eight reports. And if you look, in 2024, we never got below 40% bears. Back in 2021, we never got below like 40, 42% bears. But you look back in 2022, and you can see we're down to similar levels. And again, I have this blue horizontal line to show where we're at, so we can see that we're very clearly down on the range that we were in 2022. Now, a lot of people see this very negative bearish sentiment and say, well, is the sentiment so negative that it's actually bullish? Fair point, and that's a way that a lot of people use sentiment indicators. But two comments that I think should quickly dispel how we can use the AAII survey for that particular contrarian approach. Number one, the most negative reading that we saw was about a month ago, right? 3 weeks ago in late March, second only to this negative 60% reading that you saw the last week in February. Now, that last week in February, we got down to around 60% bears. That was there. Okay, that was there, but actually, sorry, that was this bar right here. So the bulk of the deterioration has happened after the AAII survey switched so bearish. So while eventually the low will probably be marked by a very bearish reading, right, a very strong bear vote in this survey, you can see that some of the most negative readings you're going to see are not necessarily at the low. They're actually earlier on within that distribution phase, because what I found with the survey is it never really gets below 15 to 20% bulls. It seems like there's this group of respondents in the AAII survey that are just always bullish no matter what. And there are also some people that are always bearish. And no matter how good the market looks, you can still see that even in the most bullish market reading, there's still about 25% of the respondents that are bearish. So it's all about the rest and how they switch, right? Kind of the swing votes that go from bullish to bearish, or, and there's neutral in the middle that some of them may be rotating to for sure. Having said that, I find the survey is more anecdotal, more descriptive of the investor sentiment at any given point. And I would say if you look at the extreme bearish readings, they started back in February. They've remained fairly bearish, except for 1 week where we had a bit of a spike here, but it still remained fairly negative. So overall, I would say the AAII survey still remains quite bearish. And I would be encouraged when you start to see an improvement in price more than anything. I mean, I think at this point, the sentiment tells you we're in a bear phase until proven otherwise, sort of backing up what we saw with the chart of the VIX. All right, the last sentiment indicator I'll talk through with you, and there are actually two on this chart. The top, there's the weekly chart of the S&P, same as we saw before, and then the black histogram is the NAAIM exposure index. The bottom histogram in red is the Rydex flows, and let me explain both of these in turn. So the black bars represent the NAAIM exposure index. That's the National Association of Active Investment Managers. Another podcast episode I did earlier this year in 2025 was with Ryan Redfern. He's a money manager based in Austin, Texas, and he also is the president of NAAIM and votes in the survey. So I got to interview him and ask him questions about how he votes and why, how he uses the indicator. We looked at some examples together, so I would check that one out as well if you want to learn more about this particular indicator. But how I use it is basically it's a weekly survey of money managers, and they are asked for their positioning, right? How are you positioned in the equity markets right now? And you can go, I think, up to 200% long. I believe you can go down to 100% short. So there's a 300% swing from leveraged long stocks to basically 100% short portfolio. And so the aggregated value basically shows you that total average positioning based on all of those responses. Now, if you look at the February market peak, the indicator was around 92%. That's not the most positive that I've seen it. For example, like early 2021, it got above 110%. That's one of the highest ratings I've ever seen following the indicator for a number of years. Here earlier in 2024, like at the March peak, you saw a level above 100%. Anytime the indicator gets above 100%, I tend to be a little concerned about euphoric over bullishness, right? It's a little more overconfidence in market upside, but it doesn't necessarily signal the end of the world. It's worth noting, by the way, on the NAAIM exposure index, the highest reading we've seen in the last 6 months was at the December peak, where it got to right almost exactly 100%. The February peak didn't get much above 92%. So a bit of a divergence in this indicator, the sentiment gauge going into that February market peak. But look at what's happened since the February peak. And for the next 8 weeks, you can see that, besides last week, which is a bit of a bounce higher, 2 weeks ago, which is a little bounce higher. Here's last week's reading. This week, this is just a placeholder because we don't have the new data. It'll come out on Thursday. But as of end of last week, the indicator was at 35%. So what this tells you is money managers in this poll in mid-February are saying they're 92% allocated to equities, and here as of the end of last week are down to 35%. Now, depending, you can have an average weighting of equities maybe in the 60 to 80% range, depending on where you're at in your investing life and what sort of risk you want to have. But a level of 35% is very defensively positioned. Now, I have this horizontal pink line, so you can see back to when the NAAIM exposure index has been this low. And number one, you may notice it's not that common, right? And pretty rare. The last time we were this low was actually at a major low in 2023, going into that October low. But also note, we got there in August. We also got that in September, and all of that happened before the eventual low took place. You can also see negative readings in February of 2022, certainly in the spring and early summer, and then going into the eventual low in the fall. All during that period, we had a number of times where the survey data got that negative. And before that, you have to go back to the COVID low in 2020, coming off of that peak in February of that year. So again, similar to what we talked about with the VIX, similar to what we talked about with the AAII survey, the sentiment reading here demonstrates that money managers in this survey, while I've heard a lot of speculation that institutions are buying in on weakness, surveys I'm looking at actually indicate the opposite, suggest that at least money managers in this survey have been lightening up and continue to do so through the end of last week, which is the latest evidence that we have. The last one here on the bottom, I kind of like to look at along with the NAAIM exposure index because it's also based on positioning, but this actually looks at flows within the Rydex family of funds. Now, the Rydex funds used to be a much bigger deal before ETFs and index funds and all the passive products that have just exploded in the market, and so many 401ks kind of passively aiming at index funds and similar allocations through target date funds. But back in the day, the Rydex family was a really good family to watch, a family of funds, because there were offense, defense, stock and sector funds, money market and bond funds. And by looking at the flows within the Rydex family, it was pretty common that someone would put their money in the Rydex funds and then just rotate between them. The world's kind of changed here, and a similar thing happened with like the Fidelity Select funds. It used to be it was sort of a closed universe, so you could track where investors were rotating. It's changed a bit here, but I still like to keep an eye on it because I found generally when the market's going up, you see investors in the Rydex funds sort of going into more offensive funds, things like stock funds, growth funds, sector funds, that kind of thing. When the market starts to rotate lower, you will see investors rotate to more defensive positionings, particularly money market funds and sort of cash-like things, treasury bills, and that sort of thing. Now, this I've plotted upside down so that it matches more closely what we'd see with the price action and with the NAAIM exposure index. So when the values get higher, so when the bars get further away from the zero line, when it gets lower on the chart, that means investors are getting more defensively positioned. When it gets very, very close to the zero line, that means investors are more offensive. So you can see over the last 6 to 8 weeks in the Rydex funds, we've seen flows more to the defensive side of the ledger. But what concerns me, and not to finish on a low note, but if you look back, you can see that in 2022, going into the COVID low in 2020, even the sell-off in the fourth quarter of 2018, in every one of those instances, this Rydex funds data got a lot more negative. We're actually still pretty positive when you look at historical averages. We're at a new 12-month low, right? So we're the lowest we've been since October of 2023. But in protracted bear markets, you can actually see this Rydex flows data get a lot more defensive. And so that concerns me that there's actually room to go even further. There's room for investors to get even more defensive if they see more and more data, more uncertainty, more instability. Maybe that indicator continues to go lower. So certainly something to watch. So those are some of the key sentiment indicators that I'm watching here. We talked about volatility. We even looked at the VIX of the VIX and noticed that was increasing as well. So we got plenty of volatility to go around. The AAII survey, again, looking very similar to previous bear market phases. And when you look at positioning data and survey data relative to positions, things like the NAAIM exposure index, pretty defensive. When you look at the Rydex flows, defensive, but not at an extreme low yet. So all together, looking at these sentiment indicators tells me market's guilty until proven innocent. I continue to see reasons why the market could certainly continue to go lower. We'll keep a watchful eye on the chart of the S&P 500, but for now, I'm on the defensive side and continuing to cautiously watch the market drift lower. That'll do it for today. Thanks so much for watching me here on Stockcharts TV. As always, don't forget my market recap show is every day after the close, 5 p.m. Eastern, 2 p.m. Pacific, and you can find that over at my YouTube channel called Market Misbehavior. Also, a lot of great interviews on our Market Misbehavior podcast. You can find that on my YouTube channel as well. Also find it on Spotify, anywhere else where you get podcasts. But for now, I'm Dave Keller telling you, have a great evening, and remember, it's always a good time to own good charts.